Good morning. Today we'll discuss components of options. In our previous videos, we have discussed derivative markets, options, types of derivative market, etc. Options, forwards, and swaps. Today we will discuss options and components of options. We know there are two components of options. First one, that is call option, and another one, that is put option. We know call option means is the right to buy or right to purchase. The owner or buyer has the right to purchase, and the seller has the obligation to sell the specified number of securities of underlying stock at a specified rate prior to the option expiry date. Call option, when it is written against the assets owned by the option writer, is called covered option. I will repeat. A call option, when it is written against the asset owned by the option writer means seller, is called covered option. And the one written without owing the asset is called naked option. Okay. A call option is the right to buy the shares at a agreed price. Clear? That's called a call option. And next one, that is buy put option. Put option is the right to sell. The owner or a buyer has the right to sell, and the writer means seller, has the obligation to buy a specified number of underlying asset or underlying shares at a specified price prior to the expiry date of options is the definition. That's called the put option. Simply we can say that the put option is the right to sell. Then next, that is players in the option market. Simply development institutions, mutual funds, domestic and foreign institution investors, brokers, retail investors are the players in the option market. I think there is no need of explain these institutions. We know who are the development institutions. Then mutual fund, foreign FIIs, foreign institution investors, brokers, and retail investors. Then next, advantages of investors, advantages of option to the investors. First one, that is it protects the interest of investors. How it protects? Investors choose a trade on option because a number of advantages, many one. Let us list some of them. First, an option protects the investors from the risk of volatile price. Volatile means changing, or price fluctuations, as they cap the loss that the buyer of the contract has to bear. The only risk is the premium paid. Only one risk is related with option is the premium paid. Okay, and in such a way that helps to protect the the risk related the volatility of price fluctuation. The next, non-limited risk. In the case of option, the maximum loss that an investor may suffer is predictable, or it can be decided in advance, or which is equal to the premium or price of option. No more risk. That is non-limited risk. Then there is also another important, that is there is a very possibility that an investor may gain huge profit if the condition is favorable. Okay, if he is able to manage his risk, he can earn a huge amount of profit. The next, wider investment choices. Option offer wider choices to invest as regards investment is concerned. A number of risk return combinations which would be available. Okay. The next, leveraged speculation. Speculation we are already discussed. Leveraged speculation means most of the investors favors option because a given amount of money can be employed to make a greater bet on the price of underlying. I will give an example for that. An investor expecting price of shares on ONGC to rise, purchasing, for example, 700 shares of ONGC. You would require a large amount of cash, this investment. So investors in option will be required to pay only one, he will require only to pay premium amount, not the value of underlying asset. Thus, investor could acquire enough ONGC options to earn huge amount of profit if the price rise in future. So that is a leveraged speculation. The next, reduced cost. That means this option helps in reducing total portfolio transaction cost. The next, arbitrage. That means investors engaged in arbitrage process aims at making profit from price discrepancies prevalent in different markets. So that is a arbitrage. They watch for changes in the price and buy when current price is higher than the exercising or experiencing price. That is called arbitrage. Okay, then last, large profit potential or profit possibility to earn huge amount of profit. Potential of profit for the option, both call option or put option, is much higher than compared with the other contracts like future contract or swaps. Okay, that's all about advantages to the investors. The next, types of options. There are different types of options we have. Stock option, stock or equity option, stock index option, currency option, commodity option. Let us briefly explain. Stock or equity options, as already stock or equity options, the buyer or the owner carries a right to buy or sell a certain specified a number of equity shares of a particular firm. That is called the equity options. Usually these numbers or a number of, we are already discussing number of equity shares. Number usually is commonly using 100 shares. There is a transfer of stock from one party to another party at a predetermined price in future. The exchange take place in stock markets. Okay, that's all about it. Has the fluctuations in price of stock with time. The holder of stock option does not receive dividend or vote in company meetings. Only because of it is transferable. The firm does not issue the options and receives no money for them. If the holder of stock option exercises options, he end up acquire or selling the underlying equity shares. So mere equity share option. The next, stock index option. That means that enable the investor to trade on general stock market movement. The stock market indices or indexes or these index option deals that are settled by the payment of cash. The amount of cash settlement is equal to the difference between, please listen, the amount of cash settlement is equal to the difference between the exercise price and the option price and the closing price of the index. How to calculate index? We are already discussing in our various subjects like index numbers. Sigma P0, P1 divided by P0, P1, like that. Many techniques we have to calculate index numbers. So based on, we are playing this index numbers. Okay. The owner of call option would receive cash instead of stock, and seller would make cash payment instead of handling shares. So that is the difference between these equity options and stock index options. The next very important one, that is currency option. So common option, that is trading is based on the exchange rate between the currencies of two countries or other countries. That is a contract to offer a right to buy or sell foreign currency at a predetermined price at a future date. The nominal value is the amount of one currency required to purchase a given amount of currency of other country. That provide the protection to the owner or a buyer against the adverse inflation in the exchange rates. Now we are observing these currency options. The next last one, that is commodity option. That is option in commodity markets. That is a contract that is entered into only for those commodities that are traded continuously. Commonly we are trading gold. The option may be based directly on the commodities price, but in practice most of the commodities are not traded in continuously in markets, and there is a single posted price available. Okay, so that's all about types of options: stock option, index option, currency option, and commodity option. By these words, let us conclude today's video, and let us have another video tomorrow. We will discuss futures and forwards. Okay, thank you to all.